The final estimate of US Q2 GDP showed an annualized growth of 3.8%, bouncing back from a minus 0.6% contraction in Q1. At first glance, it implies that the US economy is holding up well despite tariff policies, but a closer look tells us a different story. The rebound was largely driven by a steep drop in imports in Q2, following a record surge in imports in Q1, which sharply narrowed the trade deficit in Q2. When the trade deficit gets narrowed, the GDP number gets boosted. In other words, critics are saying that the headline growth of the US GDP wasn't powered by a strong domestic demand, and it was mostly a boost from collapsing imports. In the GDP calculation, we have export minus imports give us the net exports, and net exports positively correlates with GDP. So in Q2, when we have a collapsing of imports, when this number is smaller, the net export actually gets larger, causing a boosted GDP. And in Q1, when imports was surging, right, when this thing is up, we have a net export decrease as a result, and causing a contraction GDP in Q1. This chart shows you the contribution to percent change in real GDP for both Q2 and Q1, and the one we're interested to look at is imports, right? So if we look at the Q2 imports, it contributed 4.83% to the GDP growth because there is a collapse in imports. Okay, and if you look at the Q1, the imports contributed a minus 4.68% from the GDP. That's because we saw a record surge in imports in Q1. So this is telling us that Q1 contraction wasn't telling us a recession, and the Q2 rebound isn't evident of a booming economy. So both were distorted by the effect of the tariff policy, not a genuine change in underlying demand or economy. In Q1, businesses braced for higher tariff by aggressively importing goods ahead of time to try to get it done before the tariff policy gets implemented, building up inventory, and which caused a drag on GDP. And then in Q2, instead of paying higher price to import more, they simply drew down those inventories. So this apparent strength in Q2 GDP was just a reversal in the imports. Okay, it doesn't seem like a organic economic growth. So what is going to happen for Q3? What's the Q3 outlook? A lot of economists are expecting that by third quarter, the excess inventory accumulated in Q1 will likely mostly be depleted. Okay, so at that point, business may have to be forced to restock, which means the imports would rise again. So putting a negative pressure on the Q3 GDP. And those imports will come at a tariff-inflated price because the tariff policy is in place. So which creates a double whammy or double hit. So number one is there will be a negative GDP impact because import rises in Q3. It will again act as a negative drag on the GDP growth. Number two is inflation impact because you're importing at a higher tariff environment, so the stuff that's coming in are more expensive. Some companies will absorb the higher cost, but some will have to pass it down to the consumers, pushing the price higher. So in short, some economists are saying Q3 is going to look pretty stagflation. Okay, we have a weaker growth, weaker GDP caused by imports, and a stronger price pressure caused by tariff. However, this has not played out as expected. If we look at the Atlanta Fed GDPNow estimate for Q3 GDP, the picture appears to be surprisingly strong. Right now, the model is calculating a GDP annualized growth of 3.8%, which is same as the Q2 growth. But this estimation model isn't just an early stage guess because nearly 2/3 of the quarter's data is already baked into the calculation. Because Q3 covers the month of July, August, and September, and we're already in early October, meaning that the July and August data is pretty much all fully reflected in the calculation. So only September's data are pending. So at this point, It's 2/3 of its data. Q3 estimation is shaping up to be a very solid quarter. And interestingly, if we look at the contribution to GDP growth for net exports, Q3 is calculated to be so far a positive 0.58%. Means that the imports for Q3 has not surged yet, which goes against the earlier concerns from some economists that in Q3 American business have to restock, right? And put a drag, would drag down the GDP. So, but I think this doesn't necessarily 100% invalid the thesis, right? There's still a chance, because we still have 1/3 of data not coming in yet. There's a chance that those data can be bad. But also there's a chance that the import surge is delayed into Q4. So maybe in Q3, there's still a lot of trade deals being negotiated. So companies want to wait until the trade deals are negotiated to have a clearer picture. So maybe they're still drawing down on their inventory in Q3. So maybe the surge in imports will happen in Q4. But there is also a possibility that some of the import demand in US has been permanently lost. Demand destruction for certain imports, right? Not saying America become a trade surplus country, it's still trade deficit, but some of the imports demand are completely disrupted. There's some sort of structural change because as US cranks up its local manufacturing capability, maybe some of the imports are not needed anymore. Okay, they can be fulfilled by local producers. So overall, it shows us how resilient the U.S. economy is by being able to have a strong Q3 during such a harsh economic policy backdrop. Thank you very much. Please like and subscribe.